Okay, so looking ahead to 2026, it seems like two financial giants are on a collision course. On one side, you have the US dollar, the bedrock of the global economy, and it's starting to show some serious signs of weakness. Then, on the other side, you have this disruptive force of cryptocurrency, which is now, believe it or not, being embraced by some of Wall Street's biggest players. And according to analysis from heavy hitters like JP Morgan and Grayscale, this convergence could really reshape our financial future. Let's break down what's actually going on here.
So this is it. This is the big question that could define the next decade of finance. I mean, for generations, the US dollar has been basically untouchable, right? But as we head towards 2026, that solid foundation is starting to show some cracks. And now even the most seasoned experts are starting to question its future. And look, this isn't just random speculation. We've got top strategists like Mira Chandan over at JP Morgan pointing to really fundamental issues, both cyclical and structural things that are turning the tide against the dollar. This expert consensus, this is really the first key piece of the puzzle for a 2026 forecast. To really get a handle on this convergence, we'll first dig into the dollar's uncertain future. Then, we're going to explore the rise of digital assets, and this institutional stampede that's fueling it. And we'll see how this is breaking old market patterns. And then finally, we'll connect all the dots for your 2026 forecast. All right, so let's start with the world's reserve currency. Why exactly is the outlook so cloudy? Well, it really comes down to a few key pressures. So here's the first major headwind for the dollar, a huge structural debt problem. I mean, this chart from Grayscale's research is pretty stark. U.S. public debt is projected to eclipse the size of the entire economy. Think about that. When a government owes more than its country produces, it starts to raise some really serious questions about future inflation and, well, the long-term value of its currency. And beyond that long-term debt, there's a more immediate pressure: interest rates. Right now, the markets are basically pricing in more rate cuts from the Federal Reserve all the way through 2026. And to put it simply, lower rates just make holding dollars less profitable for foreign investors, which, you guessed it, adds another layer of downward pressure. So what does all this actually look like in practice? Well, JP Morgan's 2026 forecast shows the dollar losing ground. The prediction is that by the middle of the year, it's going to take more dollars to buy a euro, and your dollar is going to buy you fewer Japanese yen. This is that weakness analysts are predicting, but, quantified. So, if confidence in the dollar is wavering, where is all that money looking to go? As these doubts grow around traditional currencies, investors are naturally searching for alternatives. And that brings us right to the rise of digital assets. Grayscale's outlook really boils this momentum down to two powerful themes. First, the very macro risks we just talked about, the debt, the rates, are fueling a search for other places to store value. And second, and this is absolutely critical, the regulatory fog around crypto is finally starting to lift. This is creating a clear, compliant bridge for traditional finance to finally walk into the crypto world. And let me tell you, that bridge is already seeing some heavy traffic. This isn't about individual retail investors anymore. We're talking about the arrival of what they call slow-moving capital. These are the giant pools of money managed by the world's largest financial institutions. I mean, just look at the sheer scale of this shift. Since the approval of these new crypto investment products, a staggering $87 billion of institutional money has poured in. That is not a trickle, it's a flood. And the key takeaway from the analysts is that this is really just the beginning. So who are these new players exactly? We are talking about wealth managers who handle trillions in assets, huge institutional portfolios, prestigious university endowments like Harvard's, and even massive sovereign wealth funds like Abu Dhabi's Mubadala. This is a fundamental change in who is buying digital assets. Now, this influx of serious, long-term capital is having a profound effect on how the market behaves. For a long time, the crypto market was defined by this really volatile boom and bust pattern. They called it the 4-year cycle. But with institutional money entering the game, that cycle may finally be breaking. The difference between then and now is it's just stark. Past cycles were driven by retail hype, right? And that caused these wild, unsustainable price surges of over 1,000%. The current cycle is different. It's being driven by the steady, persistent buying of institutions. And yeah, a 240% increase is still massive, but it represents a much more measured and stable advance than what we've seen before. So, with these institutions acting as kind of a stabilizing force, the risk of those dramatic 80 to 90% crashes that defined previous cycles, well, it's now considered much, much lower. In short, the market is maturing.
Okay, so let's put it all together. We have a weakening dollar on one side and a maturing, institutionally backed digital asset market on the other. How do these converging trends really shape the forecast for 2026?
So, here's how the forecast for 2026 really takes shape. Grayscale is predicting two major crypto catalysts: new, clearer legislation and a potential all-time high for Bitcoin in the first half of the year. At the same time, JP Morgan expects the Fed to keep cutting rates, which pushes investors away from the dollar and towards alternatives, like Bitcoin and Ether. It's like a perfect storm of converging factors.
And all of this leaves us with one final, really fascinating question. As all this institutional capital flees a weakening dollar and embraces digital assets, we have to ask ourselves, are we actually witnessing the moment where traditional money and digital assets begin to switch roles? Is this the great convergence that will redefine finance for the next generation?